Paul, are we seeing a bit of an infrastructure bubble in certain markets amid all this enthusiasm for infrastructure investment?
I don't think so. You should differentiate between, let's call them primary markets and secondary. Primary, which is just investing in new assets and building, isn't a bubble. I think that's just addressing the need we've all described, which is there is a big need to develop infrastructure in both developed and undeveloped countries. A slight bubble, one could argue, in the strong appetite for, in the secondary market, buying assets which are up and running at very low discount rates and high levels of debt. And I think that's, like other markets you've seen, has been really pretty aggressive recently, and I suspect will back off slightly. But I wouldn't call it a bubble. It's just the pricing perhaps on secondary sales of assets will come down a little bit, but not that much, over the next 12 months. So I wouldn't go as far as to say it's a bubble that's burst. It's a bubble that's perhaps not inflating as quick as it has in the past.
It is interesting, the phenomenon of the infrastructure funds. What we've all, I think, identified is that they're interested in the so-called secondary market, acquiring and operating existing so-called brownfield assets. And the prices that they're paying are very aggressive, and there are about, one statistic that I heard recently was there are about 150 infrastructure funds in the world. I mean, it might not be quite that many, but it's certainly above 100. And these, apart from Macquarie and some of the Canadian pension funds and other Australian funds, didn't really exist until, 5 to 10 years ago. But really, I think what the OECD report does highlight, and what we're highlighting now, is the need for origination of new infrastructure assets. And somehow or other, I feel that governments are missing a trick if, now that infrastructure has been identified as a recognisable asset class for pension funds to invest in and the like, that they don't somehow or other, and this is probably where Andy can help us, that they don't meet this huge demand on the one hand for new infrastructure and enhancing existing infrastructure with this rise, this absolute tidal wave of money that's looking to invest, as more and more countries are telling people to make their own private pension provision. And in the case of Australia, in fact, Australia is creating a sovereign wealth fund which is going to collateralise existing Australian pensioners because they're trying to match the long-term liabilities which Australia as a nation-state has to its pensioners with the fact that Australia now no longer has any national debt, because, of course, increased price in minerals, etc., etc., etc. That's another debate. But it's interesting that we need to match the need to invest in infrastructure and create new infrastructure with the real desire of the infrastructure funds and others to invest in that asset class.
Can I just do an analogy there in the corporate world? In the corporate world, so many companies will look at their balance sheet and look where perhaps they're not realising value or where it's undergeared. So, for instance, operating companies with a big asset portfolio or property portfolio may gear up against those or do a sale and lease back, realise value from that, and then invest it in what they're good at, what their new business. Going back to governments, we're in the same situation. Governments are short of cash to invest in infrastructure, but a lot of them are sitting on effectively underutilised assets, where if they were thinking of either privatising or bringing in private sector capital into roads, into basic infrastructure, there is a vast class of investors who would take that for them, and governments could recycle that cash elsewhere into building new assets and new long-term infrastructure. So there's a real opportunity, effectively, to tap that investor base and use that money for good effect.
A lot of comments have been made. I think go back to a couple. One is, has there been a lack of investment? I think, and I speak for the UK only, that the danger we have is using the term infrastructure across a huge number of areas. I think in terms of, certainly I'm coming back to social infrastructure, there has been an enormous and unprecedented investment in things like hospitals, schools. I think one of the challenges about how do you really widen the programme comes back to one of the things that Paul's talked about, is what is the right mechanism actually to engage. And I think there are certain investments where it's clear that the return, that the investment generates its own return. I think for a lot of infrastructure that isn't the case, and therefore I think getting the right model is important. And recently the announcement of Crossrail going forward, a lot of discussion about who should pay for Crossrail, who are the beneficiaries of Crossrail. And the private sector certainly was asked to contribute, and those who were seen to benefit from the Crossrail project, whether it be from business rates or those who are perceived to benefit from the investment. So I think getting the model right is very important. I think the comment that government is sitting on assets that could be realised for value absolutely is right, and I think government should look which assets is it realistic to raise proceeds and reinvest those proceeds into infrastructure that may not pay for itself in a direct way. And I think when you look at the public-private partnership model, which is a way of sort of transferring certain risk to the private sector, but recognising the ultimate payment stream is a public sector payment stream, is a model that is being adopted around the world and aggressively adopted around the world. So I think the key issue, I think the need for infrastructure is absolutely clear. The key issue is what is the right model for a given infrastructure, and it will vary case by case.